Today, we're doing a complete breakdown of International Financial Reporting Standards 9. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying IFRS 9, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine banks previously underestimating bad loans by billions, only reacting once defaults hit. International Financial Reporting Standards 9 transformed this by requiring proactive planning with realistic loss estimates. After this section, you'll grasp how International Financial Reporting Standards 9 brought transparency to financial asset reporting, making balance sheets more reflective of true financial health. International Financial Reporting Standards 9 was introduced to address the complexity and lack of transparency in IAS 39. Before International Financial Reporting Standards 9, incurred losses often revealed too late in financial crises. The forward-looking model now proactively addresses potential credit issues early. This proactive approach increases financial stability and ensures investors receive a more accurate view of financial health across balance sheets. Effective from January 1, 2018, International Financial Reporting Standards 9 applies universally to entities with financial instruments. Whether you're a bank, insurer, or any business holding these assets, compliance is crucial. The expected credit loss model is the cornerstone, demanding earlier recognition of possible credit losses. This shift from delayed to proactive recognition helps prepare for downturns and informs stakeholders with timely and accurate financial reporting. The expected credit loss model shifts focus from incurred to anticipated losses. Unlike the past, it considers future expectations, enhancing risk assessment. By analyzing macroeconomic conditions and specific entity factors, it categorizes assets into 3 stages: performing, underperforming, and non-performing. This method matters in interviews as it demonstrates how International Financial Reporting Standards 9 provides an early warning system for credit risk, vital for financial stability and investor trust. Understanding the scope of International Financial Reporting Standards 9 is crucial because it dictates what entities must include or exclude in financial reporting. A common pitfall is forgetting that equity instruments held for trading are not covered, which can trip up many candidates during interviews. Mastering these details separates you from the pack. Understanding what International Financial Reporting Standards 9 applies to is crucial for accurate financial reporting. It covers financial assets at amortized cost, like loans, and assets at fair value through other comprehensive income, such as bonds. Financial liabilities, including bonds and derivatives, are also included. Remember, hedging instruments are part of this too, especially for multinational corporations. International Financial Reporting Standards 9 explicitly excludes equity instruments held for trading, like stocks, because they are speculative. Insurance contracts are another exclusion, governed by International Financial Reporting Standards 17. Leases are also outside its scope, addressed by International Financial Reporting Standards 16. Remember, non-financial items like inventories and property don't fall under International Financial Reporting Standards 9, a classic interview trap. A financial instrument is a contract that results in a financial asset for one party and a financial liability or equity instrument for another. Think of a loan agreement. It creates a financial asset for the lender and a liability for the borrower. This definition includes everything from simple bank deposits to complex derivatives. Expected credit loss, or ECL, is a forward-looking estimate of potential losses on a financial asset. It considers past events, current conditions, and future forecasts. For instance, a bank might use ECL to predict future losses on its mortgage portfolio. This approach helps in maintaining adequate reserves against potential default risks. Navigating scope edge cases in International Financial Reporting Standards 9 can be tricky, especially during interviews. Imagine holding a government bond to maturity. It falls under International Financial Reporting Standards 9 if measured at amortized cost. However, a speculative stock option doesn't. Leases? They're International Financial Reporting Standards 16 territory. Reinsurance contracts are excluded, governed by International Financial Reporting Standards 17. Companies often face unexpected credit losses that impact financial health. The expected credit loss model addresses this by forecasting potential losses, enabling firms to set aside necessary provisions. Imagine Meridian Corporation managing a $10 million contract, needing to predict and prepare for credit risks. This model helps them strategically allocate resources, supporting financial resilience. The expected credit loss model forecasts potential credit losses, crucial for financial stability. We'll follow Meridian Corporation's $10 million SaaS contract, covering software and services over 3 years. See how they identify financial instruments, classify assets, assess business models, measure losses, and record impairments. This end-to-end example illustrates the model's strategic value in anticipating risks and safeguarding assets. First, Meridian Corporation must identify all financial instruments within International Financial Reporting Standards 9 scope. Their $10 million SaaS contract includes an $8 million software license and $2 million in implementation services, qualifying as financial instruments. A common mistake is overlooking key instruments like receivables due to misclassification. Accurate identification is vital, as International Financial Reporting Standards 9 mandates precise recognition to ensure compliance. This foundational step sets the stage for subsequent classification and measurement. Meridian Corporation must now classify these instruments into categories like amortized cost, or FVPL. Their $8 million software license falls under amortized cost, while the $2 million services align with FVPL, building on Step 1's conclusions. Misclassification often arises from confusion over cash flow characteristics. International Financial Reporting Standards 9 stresses accurate classification to reflect true financial positions, impacting reported earnings and financial strategy. Next, Meridian Corporation evaluates their business model, focusing on collecting cash flows from their $10 million contract. This assessment confirms their previous classification decisions, emphasizing the intent to hold assets for collecting cash flows. Many overlook how business models influence asset classification, leading to errors. International Financial Reporting Standards 9 requires alignment between how assets are managed and classified, ensuring reliable financial reporting that supports strategic business objectives. Meridian Corporation now measures expected credit losses applying a 3-stage model. For their $8 million software license, they calculate 12-month ECL, building on the business model assessment. Overestimating losses is common, often due to incorrect staging. International Financial Reporting Standards 9 structured approach ensures precise loss measurement, aligning financial projections with reality. This stage's outcome directly impacts financial reports and prepares Meridian Corporation for potential credit risks. Finally, Meridian Corporation recognizes and records a $100,000 impairment loss, derived from the expected credit loss calculation. This step concludes the model by ensuring financial statements accurately reflect potential credit risks based on Stage 4's outcome. Often, companies delay recognizing impairments, distorting financial results. International Financial Reporting Standards 9 emphasizes timely recording to maintain transparency and financial integrity, safeguarding Meridian Corporation against unexpected financial downturns. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. International Financial Reporting Standards 9 gives options from fair value to amortized cost, each with different implications for financial reporting and disclosures. Recognizing financial assets at fair value is crucial. For instance, a $100,000 bond purchased is recorded at its market value on the transaction date. This includes transaction costs, unless classified at fair value through profit or loss. Understanding when an entity becomes a contractual party ensures timely recognition, affecting financial statement accuracy. Subsequent measurement involves choices that impact income statements and balance sheets. For example, a loan measured at amortized cost will differ in presentation and value impact compared to one at fair value through OCI. Significant credit risk changes trigger remeasurement, affecting both reported asset value and expected loss provisions. Financial statement presentation demands precision. Assets measured at fair value through profit or loss show gains directly on the income statement. Contrastingly, those at fair value through OCI reflect changes in equity. Balance sheets must clearly separate financial assets and liabilities, ensuring stakeholders accurately interpret the entity's financial health. Disclosures under International Financial Reporting Standards 9 aren't just technical, they're practical. Knowing how an entity determines fair values aids stakeholders in assessing management's judgment. Understanding credit risk management offers insight into financial stability. Disclosures about impairment losses and hedge accounting reveal true financial health and risk strategies, ensuring informed decision-making. Imagine a CFO choosing amortized cost for a $500,000 loan. This decision stabilizes the interest income stream, essential for planning cash flows. In contrast, a $200,000 equity investment at fair value through OCI boosts equity without hitting earnings, balancing short-term performance with long-term growth. These choices require keen analytical skills and strategic foresight. Meridian Corporation, a global manufacturing company, issues a $1 million bond to finance new equipment. Discover how each accounting event unfolds, affecting the balance sheet and profit or loss. Watch as we navigate International Financial Reporting Standards 9 requirements from initial recognition through to maturity. Meridian Corporation raises $1 million by issuing a bond, increasing cash for new equipment. International Financial Reporting Standards 9 requires recognizing financial liabilities at fair value. This entry sets the stage for future interest payments, influencing balance sheet liabilities and cash flow. Meridian Corporation accrues $50,000 interest on the bond, recognizing borrowing costs in the current period. International Financial Reporting Standards 9 mandates this to accurately capture financial expenses. This impacts profit or loss, reflecting liability growth. Interest payment of $50,000 is made, reducing cash and clearing accrued interest. International Financial Reporting Standards 9 requires this to show accurate liability reduction. Meridian's cash flow statement reflects this outflow, maintaining transparency in financial reporting. Meridian Corporation invests $1,000 in new equipment using funds from the bond issuance. International Financial Reporting Standards 9 records this as a significant asset increase. The balance sheet now reflects improved production capability, while cash reserves decrease. Depreciation of $100,000 is recorded, reflecting annual asset wear. International Financial Reporting Standards 9 necessitates this to match expenses with revenue. Meridian's profit or loss reveals this cost, with accumulated depreciation impacting asset book value. Adjusting the bond's carrying amount by $20,000 aligns with International Financial Reporting Standards 9's fair value measurement principle. This reflects market conditions, impacting liabilities and financial gain. Users gain insight into Meridian's real-time financial position. The $1 million bond principal repayment closes the loop on Meridian's financing activity. International Financial Reporting Standards 9 mandates derecognition, removing liability from the books. This major cash outflow reduces financial obligations, showcasing prudent debt management. Every Big Four and investment bank interview on International Financial Reporting Standards 9 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. International Financial Reporting Standards 9 is a financial reporting standard for financial instruments, replacing IAS 39. It exists to improve transparency and comparability by aligning the classification, measurement, and impairment of financial assets with current market practices. A big change is the shift to an expected credit loss model. Candidates often forget how International Financial Reporting Standards 9's forward-looking approach anticipates potential defaults, significantly affecting provisioning strategies. International Financial Reporting Standards 9 classifies financial assets into three categories: amortized cost, fair value through other comprehensive income, FVOCI, and fair value through profit or loss, FVTPL. The classification depends on the business model and cash flow characteristics. Watch out for confusing these with IAS 39 categories, which differ significantly. Key takeaway: always align asset classification with strategic business models. Under International Financial Reporting Standards 9, companies record an impairment loss based on expected credit losses. For example, If a company projects $100,000 in credit losses, they immediately record this in earnings, adjusting the financial asset's book value. The mistake to avoid is using incurred loss models from IAS 39. Remember, the expected loss model requires forward-looking assumptions. Under International Financial Reporting Standards 9, macroeconomic factors such as GDP growth, inflation, and unemployment rates directly influence expected credit losses. Financial institutions must adjust their impairment models to reflect these economic conditions. A common trap is underestimating their impact or ignoring future economic scenarios. Key lesson: always incorporate current and forecasted macroeconomic conditions in impairment assessments. Indian Accounting Standard 109 and International Financial Reporting Standards 9 are broadly similar, but key differences exist in implementation and transition provisions. Indian Accounting Standard provides specific carve-outs, such as the treatment of financial asset restructuring. Candidates often miss the nuances in hedge accounting rules under each. Remember, while both aim for harmonization, local adaptations can alter compliance requirements. International Financial Reporting Standards 9 outlines 3 stages of credit risk assessment. Stage 1 for initial recognition, Stage 2 for significant increase in credit risk, and Stage 3 for credit impairment. Each stage dictates specific provisioning rules. A common mistake is confusing these stages with past due categories. Key takeaway: understand each stage's distinct impact on provisioning. Fair value adjustment reflects market conditions, affecting both financial assets and liabilities, while impairment specifically addresses expected credit losses on financial assets. International Financial Reporting Standards 9 requires separate consideration for each. A common trap is conflating fair value changes with credit deterioration. Remember, fair value reflects current market rates. Impairment is about expected losses. International Financial Reporting Standards 9 mandates disclosures on classification, measurement, and impairment of financial instruments. Companies must provide detailed information on risk management strategies and expected credit losses. A mistake is omitting qualitative disclosures. Ensure disclosure of forward-looking information and reconciliation between opening and closing balance sheets. Takeaway: transparency is critical for stakeholders' financial decision-making. Goodwill is not within the scope of International Financial Reporting Standards 9. It's covered by International Financial Reporting Standards 3 for business combinations and IAS 36 for impairment. A common mistake is assuming all financial elements are under International Financial Reporting Standards 9, leading to incorrect impairment testing. Remember, International Financial Reporting Standards 9 focuses on financial instruments, not intangible assets like goodwill. For unexpected macroeconomic changes, companies should adjust impairment models by revisiting forward-looking assumptions and recalibrating expected credit losses. International Financial Reporting Standards 9 emphasizes agility in response to economic shocks. Candidates often neglect timely model updates, misunderstanding static provisioning policies. Key takeaway: maintain dynamic models that incorporate real-time economic data to ensure accurate financial reporting. International Financial Reporting Standards 9 aims to enhance the transparency of financial instruments reporting with a focus on fair value. It covers a wide scope, targeting nearly all financial instruments. Financial assets are categorized based on their business model and cash flow features. Liabilities can follow amortized cost or fair value metrics. Equity instruments have specific designation options. The standard also modernizes impairment and hedge accounting, making them more reflective of actual risk management. The expected credit loss model in International Financial Reporting Standards 9 emphasizes anticipating credit losses early, using a combination of historical, current, and forward-looking data. The 12-month expected credit loss applies when credit risk hasn't surged, while lifetime expected credit losses are recognized when it has. Trade receivables usually fall under the simplified approach, recognizing lifetime ECL. Financial instruments are measured either at fair value or amortized cost, with reclassification needed if the business model alters. In interviews, be ready to discuss credit risk traps, especially the implications of misjudging significant risk increases. Understand that International Financial Reporting Standards 9's expected credit loss model contrasts with U.S. generally accepted accounting principles incurred loss approach. Disclosures should thoroughly outline risk management strategies and credit loss impacts. Emphasize reclassification impacts on financials and recognize the standard's alignment with practical hedging. Complex instruments demand a deep understanding for proper classification, and significant judgment is crucial in assessing credit risk. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.